Hi there. Thanks for tuning in. Today we're going to take a look at Hanesbrands Inc., ticker symbol HBI. Let's get started. Now, what or who is Hanesbrands? Hanesbrands is essentially a big company that has multiple brands such as Hanes, Champions, Bali, Maidenform, Just My Size, etc. And together they essentially just sell clothes, undergarments, and whatnot. But yeah, it's basically a conglomerate, and it's been a conglomerate that has acquired a lot of these brands over time or created a few of these brands. Hanes and Champion are probably the two most recognizable ones out of here. I know I own a few Champion shorts. They're good. And I know Hanes is something that you can see, for example, here. I searched this today on Amazon. I just went on an incognito tab and searched hoodies. And guess what? Hanes actually appears here and here twice in the top 4 results. And it's just plain hoodies, and they have a lot of plain t-shirts, plain underwear, socks, etc. So that's more or less where Hanes as a brand competes. But they also have Champion, they also have some underwear segments, some more targeted towards ladies, others more targeted towards men, so they do have a little bit of variety there. However, that's enough about the brand. I want to get into the nitty-gritty of the actual finances here. And it's very interesting because these are the fiscal years ended for 2020, 2021, and 2022. I know we have two 2022s listed here. Just know that the first one really represents 2021, and this January 2nd, 2021 really represents the entirety of the year 2020. Now, here we see 2020 was a difficult year, so we can expect that some companies, especially retail companies that sell physical goods, such as Hanes, would have had a tough year. Yes, this happened. They had negative net income, so they had a net loss, and you would expect this to get better for 2021, which it did. Revenue was up, operating profits were up, and net income finally went positive. But then you look at 2022 and you see that revenue is back down, operating profits are down, and they're losing money again. And that's crazy. That is absolutely crazy because they're essentially back in the position where they were in 2020, except the global situation is very different. And sure, there are some reasons that relate to the global situation in 2022 that affected these results, but at the same time, they shouldn't be back where they were in 2020. They should still be better. They should still be in a better position. So let's talk a little bit about this. In their annual report, they say the net sales decreased 8% during 2022 due to softer point of sale trends and higher retail inventory levels as a result of macroeconomic pressures, the impact of the ransomware attack to the business, global supply chain disruptions resulting in product delays, ongoing pandemic-related pressures on consumer traffic in certain markets in Asia, and the unfavorable impact from foreign currency exchange rates in our international business of approximately 182 million US dollars. So, yeah, they essentially had a tough year. A lot of these things they can't necessarily control, but it'll depend a lot. We'll see whether or not they can actually recover due to the global situation in 2023 or not, right? So they had a really bad year, but if this doesn't depend on them, do we really want to depend on the global situation? Well, that's something for you to decide, but that already sounds a little risky to me. I also want to take a look at their debt. They have quite a bit of debt. They have about $3.6 billion in long-term debt, and they have a little bit more in short-term debt. So here's the mix of them. They have a lot of it in fixed-term debt, but they also have a lot of it in high-interest loans. So this is important. And another thing to keep in mind is that approximately 60% of their total debt outstanding is at a fixed rate, but a 25 basis point movement in the annual interest rate charged on the outstanding debt balances would result in a change in annual interest expense of approximately $4 million. So they are actually exposed to variable interest rates. 40% of their debt is affected by variable interest rates, and as interest rates rise in 2023, that's more money that's taken out of their bottom line because they're going to pay that extra interest for all that giant pile of debt they have. And again, if their debt is 3.6 billion, but the revenue is 6.2 billion. That is a lot of debt. That is more than 50% of the revenue, actually, that is debt. And they don't have all of this available to pay down the debt. They have this, or maybe to some extent this. So they cannot pay it off in a single year. And as a matter of fact, their cash position is also pretty negligible. They have about $200 million in cash compared to 3.6 billion in just long-term debt without counting short-term debts. So they can cover their short-term debts maybe, but their long-term debts, they're going to have to work on it for a while. Now, we also have their guidance provided, which will be very interesting. So they're saying that their net sales are going to be 6.05 billion to 6.2 billion, and then their operating profits are going to stay fairly low, fairly in line with what it was in 2022, which was less than 2021. Their interest expenses are still going to stay high. Their cash from operations is going to be about 500 million, and then capital investments are going to be 150 million, including capital expenditures of 70 million. So that's important to take a note of, and we can use this to estimate future results. So we're going to do just that. We're going to do a discounted cash flow model. Now, something that's important is that before 2022, essentially, their average revenue to free cash flow rate, how much revenue gets turned to free cash flow, was about 8%. Now, in 2022, you'll notice that they had negative free cash flow. They actually had negative cash from operations even. Why did this happen? Essentially because of change in inventories. As their inventories grew, this is a hit to their cash from operations. So when your inventories grow, it's considered a liability because you have to get rid of this. You often have to get rid of this at a discount. And so it took a hit in their cash from operations. Will this happen for another consecutive year? I don't know, but it shouldn't happen as gravely because the global situation should at least ease a little bit or shouldn't be as extreme for them. So I'm going to give them the benefit of the doubt for this calculation specifically. I could be more conservative. I could be more generous to them as well. I'm just going to go middle of the road. Benefit of the doubt, but I'm not going to say they're going to immediately recover very strongly either. And I'm going to say that they do go back to turning that 80% or 8% rather of revenue into free cash flow. And I'm going to use this guidance that they had of 6.05 billion. I'm going to say the next year they're going to have 6.2 billion of revenue. And then I'm just going to keep it flat. So yeah, these numbers from 2023 to 2026 are just 8% of this estimated revenue based on their guidance, and then a little bit of a flat growth because they have had a tough time. So I'm going to give them a flat growth because I'm going to be a little tough, and then I'm going to give them a perpetual growth rate of 2% actually, so they can grow in the future in perpetuity. They also will have a required rate of return of 11%. That's 11% I want to make per year, which is 1% more than the market. If you're making 1% more than the market every year, it's going to compound over time and be actually a lot more. And if I divide it by the total number of shares, I would get a fair value of 14.94 US dollars. However, we want to include the net debt, as we were talking about. The net debt is pretty high. So we add all that net debt, and then we subtract it from the total value of the company, and then divide it by the total number of shares. It would be $3.25 with net debt included. Now, where's Hanesbrands nowadays? Wow, this chart is something. Because, as you see, it's even below 2020 levels when the global stock markets crashed in 2020. And a lot of this is due to the fact that they had those atrocious results for their 2022 annual report. And they also used to be a pretty big dividend payer. They used to have a dividend in the 4 or 5% range. Well, now they got rid of it completely. Part of the reason why is because they want to have money accessible to pay those debts down. So if you have all your money tied up in paying a pretty chunky dividend, as you could see, well, they weren't making much in terms of profits, and they were probably giving out a lot of dividends if it's 5%. So yeah, they probably had to get rid of that dividend if they wanted to even survive, honestly. And investors just don't like that. Investors don't like when they get their dividends cut. So yeah, their performance has been pretty atrocious. If you've held it the past 5 years, you're probably not happy at all. Even if you bought it during the lows of the 2020 crash, you're probably still not happy with it at all. So that's crazy. But even then, even with this decline of 77.84% in the past 5 years, it is still above this level that I'm getting of $3.25. So let's talk about this. Where's the value actually coming from with Hanesbrands? Well, their dividend is gone, and they don't really do share buybacks. Overall, if you look at the trajectory for the last 5 years, they've bought back a little bit of shares, but not really a significant amount to make a very pronounced uptick in the total value of the stock. So there's no direct form of shareholder returns. So returns will hinge solely on a turnaround story, contingent on supply chains easing, so their inventories are also in a better situation, lowering their debt, and further growing again. This is possible, but it does come with significant risk. We saw that they had their estimations there for what next year is going to look like, but if things don't look like that, well, then this may be even lower than this calculation I'm giving of $3.25. This is very possible, but again, the risk is real. And besides, the moat is actually pretty negligible. At the end of the day, even though they rank first in Amazon, which is cool to see, they actually are just a clothing company and they have so many competitors, and it's pretty easy to get into a new clothing business if you want to start it. So they have all these competitors on Amazon. They have their own stores, but most of their sales come from third-party vendors. So this just means that with basically no moat, it's hard for consumers to stick with Hanes. I know I have some Hanes white t-shirts, but whenever I go to buy new plain white t-shirts, I am not looking at Hanes as a specific brand. I'm just kind of looking at what has a good price or comes in a good variety pack or something like that. I know I'm not going to be loyal to Hanes as a brand, and I feel like most consumers would be that way too. So that's the thing, is I have to ask, turnarounds are great, but they're risky. So is that really what you want to buy into? And it can be, if you do believe in the turnaround story of Hanes, where they cut this dividend to pay down their debt, which is something that new management has been stressing. We're going to work down the debt. We're going to work to turn around the company. But again, management is just trying to sell you into this company. That is literally their job, is to be salesmen. So they're saying this. Will it happen? Maybe. But even then, even at this level where I'm saying they go back to their historical revenue to free cash flow levels, even then, it seems to be a little overvalued. So it just depends on how much you believe in this turnaround story, and if so, it may still take a while for your returns to materialize, because Hanes is a risky stock. Things may not go the way they seem they're going to go immediately. So, yeah, you are in for a possible opportunity, but with very great risk. Now, with that said, I hope you enjoyed this video. If you have any questions or comments, feel free to comment down below. I read every comment. I'll do my best to reply to it. And with that said, I hope you have a fantastic rest of your day.